Welcome back. This is Philip at Laptop Trader Channel on YouTube. My email contact is laptoptraderphil@gmail.com. Today's video is going to be specifically on the focus of investing. So this channel and this video is for informational purposes only. Please seek qualified help if you need help investing. So what is stock investing? And why should you be an investor? One of my goals of this presentation is to alleviate some fear around investing and hopefully inspire you to start now. I hope this helps if you are considering investing in the stock market. This will be very basic and for new people and new investors. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself, then invest in the markets. So what is stock investing? When you purchase a share of a company, it is a stock or a piece of that company. One share or one stock is one piece of a publicly traded company. In general, we will be talking about the open market or publicly traded companies. You can own shares of a private company or even a partnership, but that is more of a business discussion. And some companies have ownership programs like a stock purchase program at your company. But for this video, we will be talking about companies listed on public stock exchanges like the New York Stock Exchange or the NASDAQ exchange or any other public exchange. When you purchase a stock, you become a shareholder, even if it is one share. You receive certain rights as a shareholder or owner of stock. Some of these include right to any price appreciation or depreciation, rights to any dividends, and right to vote on any company issues up for a vote. Dividends are simply money given back to shareholders as a thank you for investing in that company. They're usually paid every quarter from the profits of the company. Investing or owning shares does not really give you any control over that company as far as the decisions made in the running of that business. Those decisions are carried out by the CEO and other upper management. Owning stock also does not give any rights to collect on any debt owed by that company, and if the company goes out of business, you get nothing. The main risk for shareholders is price of the stock falling or going to zero, or the company going bankrupt suddenly. If you do an online search, you can look at Enron or Silicon Valley Bank or Lehman Brothers as examples. This happens all the time. These are three big examples. Most companies simply do not make a profit or not for long and go out of business. This is the way it is. So, as a stock investor, we need to be able to lessen or mitigate the risks involved. There's three main ways that I know of to mitigate risk of owning stocks as a shareholder. One, diversification or diversify. This is where you're spreading risk over many different stocks. Two, dollar cost averaging over time is where you buy shares over a period of time and then we get an average price over that time. So when you allocate an amount or a percentage weekly or monthly to investing. Individual stocks, we can use position sizing and share sizing. This is mainly for traders. The premise behind that is you can't lose what is not at risk. Investing for the long term. When I think of investing, I think of buying a home to live in for the long term and as saving over time. We all know of someone who bought a home several years or decades ago that on paper has experienced an increase in their home's value. Maybe they bought a house in the 1980s at $75,000. At the time, it seemed expensive. Now, today, maybe it is worth $300,000, which today is just average. By buying back then, they locked in their payment on their house, and because of appreciation and location and inflation, the home went up in value. Most people understand that housing is valuable and therefore tends to, not always, go up in value. The same thing happens with good companies and stocks in general. Over time, the market goes up in value, especially the best companies listed in the S&P 500 index of stocks. The S&P 500 is actually 505 of the biggest, best, strongest companies in the world and generally dominate their business and their industry. They go up in value because the businesses grow over time in size and in profits, and the share price goes up in value. You can participate in that growth by owning stocks. There's three types of ownership and diversification. First, mutual funds is a group or a basket of stocks. There's immediate diversification over a variety of companies. You can buy a fund based on the S&P 500 or any group of stocks in a fund of your choice. There's hundreds, maybe thousands of funds available. They can focus on a sector or an industry or an index, and the changes usually involve changing the percentages of the companies owned within that fund. One fund may mimic an index, such as the S&P 500. Another may be weighted towards a certain group, like technology or energy. One may be heavy on Apple, let's say a 10% weight, and another may be heavy on Chase Bank, for example, maybe a 10% in Chase Bank. This is out of your control. You just choose the fund that suits your needs and that you are comfortable with. Usually, your employer or financial advisor will offer you a mutual fund through a 401k or retirement account as an investment. This is considered safe over time. 2. An ETF or an exchange traded fund. Very similar in concept to a mutual fund, only they can be traded and you don't need to buy from a fund family company. Vanguard or Empower would be considered mutual fund companies who sell and manage mutual funds. They also offer the same holdings as mutual funds, and again, there are hundreds of choices in ETFs. Vanguard, Empower, and State Street and others offer ETFs or exchange traded funds. In general, an ETF is a lower cost alternative to a mutual fund, whether it is an index fund or a managed fund. A managed fund usually has employees who actively manage the holdings of that fund, and so they need to be paid to work there. By the way, most fund managers do not beat the returns of the market index over time. And so therefore, ETF investing has become more popular since they were introduced. Essentially, I can buy the same S&P index fund or a total market fund for a lower price called a management fee or a fund expense. It used to be common to pay between 1 and 3%, and even a closing fee or a surrender fee if you closed your mutual fund as a penalty for leaving your investment. Today, with ETF investing, it is very common to pay less than 0.5% or less in ownership costs. I can just go online and buy or sell that ETF fund many times for no charge. And third, individual stocks. You can own pieces of a company such as Apple or Walmart and invest in them if you like their business. Maybe you simply like their product or service and would like to take part in their success. This happens again with price appreciation and or dividend payments to investors. Some mutual funds and ETFs also pay dividends on their holdings. In general, a dividend is like a bonus, and most money made in stocks over time is through price improvement. Most major dividend paying stocks will be between 1 to 5% on the high end. Some pay quite a bit more, but there is the risk to reward factor to consider. High paying dividend stocks tend to be much riskier. Also, in general, it is considered more risky to own one company versus a basket of companies. All of your eggs in one basket. What if you drop the basket and go hungry? What if you put all or most of your money in one company as an investment? So, why diversify? Well, when you diversify or spread your risk over many companies, usually within a fund, you immediately reduce your risk over that group. If one or two companies are affected by the economy or other business factors, then it will affect the fund. However, it usually does not affect every company in the large group, and therefore your investment is more safe over time. Now, markets and funds do go up and down over the short term, but over time, investing in well diversified funds has proven to be a wise choice for investors of all sizes. Diversification is a protection from choosing the wrong company or investment. Most investors are simply not good at choosing individual companies to invest in. So then why try to choose individual stocks or companies? Well, if you like the discussion and are interested in doing some homework, yes, you can succeed in choosing to invest in quality companies. The main reason to do this is to try to get higher returns on your investing. ROI, or return on investment. One of the things an investor is always wanting to do is get a higher ROI. Investors put their money out there expecting it to return to them at a higher value or a profit. The faster it returns to them, the better ROI and the better the performance of that investment. Think about it. Would you rather have the house that went from 75,000 to 300,000 or from 75,000 to 900,000 in the better location? The obvious answer is the latter choice. It's just better. Well, isn't 5% or 10% enough of a return on my money? Well, it may be for you, but it is not about what is enough. It is about ROI and performance. We would all agree on the house scenario. Now let's use a financial calculator or compound interest calculator and use a $75,000 stock investment as an example. It can be any stock or any fund, but this is just math and how the numbers would work out over 30 years, just like a 30-year house mortgage. Only in this case, we are not paying the bank, we are investing for ourselves. According to Freddie Mac, government agency, average price appreciation is about 4.4% over the long term for housing. According to a web search, between 3 to 5% appreciation, but some areas are not. So location matters. So there's a lot of variables to that house appreciation. Using the calculator at investor.gov, I can type in 3750, which would be about 5% of 75,000, which would be a fair down payment on a 30-year loan. Only in this case will we use that as our initial investment. Also, using a mortgage payment calculator, we can figure out the payment on that loan at about $460 per month, not including other costs of ownership such as taxes or maintenance. So we will use $460 per month as our stock investment capital, or about $106 per week allocated to investing. And that's a typo. That should be very attainable, not unattainable. That's the same thing. Results of investing over 30 years. So let's take a look at this. If we assume we start off with an initial investment of $37.50 and contributed $460 per month and had a 10% ROI compounded annually over 30 years, we would have $973,000 if we stayed the course and did not contribute any more or any less over that period of time. Our total contributions over this period would be $169,350, and I'm using 10% ROI because over time that is the average market return. If we pay the same payment to the bank over the same period, the bank will receive the $169,350 on our $75,000 house that is now worth $300,000. We are just using compound interest in our favor when we invest. I'm not saying don't buy a house. A home is your life and your community and a great hedge against inflation and locks in your housing costs. But it does not compare to the stock market as a wealth creation tool. So this is just a screenshot of what I typed into this compound interest calculator at investor.gov. Okay, so we got our initial investment, a monthly contribution, which is doable plus or minus for most people that are working, on a length of time, 30 years, and an estimated compound interest rate of 10%. So you can go there and play with that calculator for yourself and check it out. It's kind of fun. And then it'll spit out this graph when you hit calculate. So in 30 years, using those parameters, this is what you would have in savings. So why don't more people invest and buy homes, right? These are two areas that clearly create some kind of wealth. You know, one may be better than the other, depending on your opinion. But I think the short, easy answer is that we don't think long term in general as people. You know, everything is day to day decisions and living for now and week to week. I think we can all relate to maybe making a poor relationship decision short term based on feelings of the moment, only to regret that relationship later on. It is always easier to say yes to not making a meal or a coffee at home and paying more for convenience at a restaurant or a coffee shop. So I think it's some complacency. Anyway, home ownership rates in America have generally been over 60%, currently over 65%. So we can recognize value in owning housing. Now, stock market participation currently is around 62%, whether through stocks or funds or retirement plans. The bad thing is that in bad times, like back in 2008, people exited the market only to see it go up again over the next 15 years. I don't know why, but it is an obvious answer to long-term economic security. This chart shows why people are bad investors. They buy and sell at the wrong time. Another case for diversification, staying the course, and buying the market. In the next chart coming up, can you see the dip in 2008 after the financial crisis? I understand there are people that can't or choose not to earn income, and that some have it harder than others, but I don't think that should persuade you not to invest and be an example and maybe help them out. I understand sometimes the economy is better than other times and for some groups. It is never easy to save and invest now, just as it is really never the right time to buy a home. It takes some discipline and budgeting and sacrifice to allocate money to investing. But you can do it and are welcome to join if you choose. So this chart shows US stock ownership trends. And here on the left side, you can see it was around 60% in the late 90s. Then it kind of fluctuated back and forth. And then it started to, stock ownership really took a dive, especially after 2008 and 2010. Kind of went up a little bit there, but then went down again all the way into 2014. And even 2016, stock ownership rates were just over 50%. So this market crash here really had an effect on people's psychology about investing. It really drove a lot of people out of the market for years, from 08, 09 all the way up to 2016, so over 7 years. And the bad part about that is this was a great buying opportunity in hindsight. And there was other buying opportunities along the way. And I think finally people recognize that, and now we're back up to about 61, 62%. So trying to time the market is a very difficult thing to do. And again, there really is not a great time to enter the market. Only in hindsight do we see the evidence of that. Just as the case with home ownership, right? When's the best time to buy a home? Well, when you can afford it. That's the best time. Now, 2008 and the COVID crash seem like great buying opportunities in the markets. At the time, it was pretty scary, and there was a lot of fear. So let's look at some returns over the last 1, 3, and 5 years using the S&P 500 ETF, which tracks this index very closely. It is highly correlated in performance. This is using a closing price on Friday of December 13th, 2024 of 604.21. So this is at all-time highs in this index and in this market. So if you hadn't been invested, you'd be missing out on a 1-year return of over 28% and a 3-year return of over 31%. Now remember, those two numbers seem close, but remember, 2022 was a down or a bear market. And we also have a 5-year return of over 88%. So this is just a chart of that index ETF, symbol SPY or SPY, as we often refer to it. And you can see over this 5-year period, we just made an all-time high closing Friday and closing this week. So, at what time in here would you buy? Well, in hindsight, it looks easy. Oh, I'd buy here, right? I'd buy at the bottom. But did you? Did you buy back in 2020? Did you buy in 2022 as the market was going down? Okay, that's the problem. If you hadn't, then you missed out on all of these returns. So now, if you're thinking, no way, am I buying out at all-time market high prices? You are wrong. Why? Because the stock market is not like shopping and looking for bargains at cheaper prices. Actually, the way it works is the market tends to make newer highs over time. So today's high will be the new low maybe several years from now. Usually stocks making new highs tend to keep making new highs, and bad investments making new lows tend to make new lows and or go out of business. When you buy a basket of stocks, you again get diversification of the good and the bad companies. Over time, the good ones outperform and the bad ones are removed from the market. A kind of natural performance sorting process that is automatic for you inside of an index fund or a mutual fund or an ETF. The best time to invest is simply now. If you are so smart and good at timing the market, did you buy in 2008 or 2009? How about 2022 into 2023 when the market turned around after that bear market? What about the bottom in 2020? How about the pullback in 2015 or 2016? If you did not take advantage of these buying opportunities, then you probably won't see the next one. You just need to start investing today for your future. One thing that has always puzzled me is why some investors are against individual stocks, especially real estate investors. They can see the potential in a single family home or a small rental property, but not in an individual company. One area I think a real estate investor may have an edge is in knowing their local market and in timing that local market. But market sell-offs in real estate are rare. They think it is too risky and I am not in control of my stock investments. If you like this content, we do trade and invest in individual stocks with limited risk. And you are welcome to watch my other videos on technical trading and investing using risk management. For me, it is safer to buy an individual company and limit my risk versus putting thousands of dollars in a single real estate investment. For the same money, I can buy several companies or stocks with very little headache or maintenance. It is my preference, and I am not against real estate investment. If you are willing to do some homework and select your stock investments, it has been worthwhile for me, and it may be appropriate for you too. But you don't have to. You can just buy a mutual fund or an index fund and do great and accept the overall market risk and returns over time. So, how to build confidence? Well, keep reading and learning all you can about the subject and take some action and buy your first investment. The most painless way to do it is to participate in a retirement plan at work. There's several good books to read on investing, and these are 5 of my favorites. Common Sense on Mutual Funds, How to Make Money in Stocks, The Snowball Effect, Stocks for the Long Run, and one up on Wall Street. One final chart. Thanks for watching, liking, subscribing, and sharing at Laptop Trader on YouTube. The S&P 500 index since 1980, and my final piece of evidence why everyone should consider being an investor. Good luck. Philip the Laptop Trader. There it is. That's the stock market since 1980. You can't even tell it the left side. It looks like zero, but it wasn't. But this week it closed at over 6,000. And you could have been investing this entire time, or anywhere in between. That ends this presentation, and we hope to see you next month in January. Goodbye.